The main differences between a long-term and short-term strategy on the stock market really comes down to risks, time, energy, emotions, and taxes. Hello, welcome back to Finance by Majella, where we go over all things investing, budgeting, and entrepreneurship, helping you find freedom. Now grab a drink, let's make millions. I assume you're here because you have a little bit of extra cash in your pocket and you're ready to start investing. Now, when I say you're ready to start investing, I don't just mean you heard your friends talking about GameStop and you thought I should probably get in on the action. There are actually a few key markers to indicate that you're probably ready to take that leap and invest in the stock market. Before we go any further, I should probably just disclaim I am not a financial advisor. None of this content is classified as financial or legal advice, and it is for purely entertainment purposes only. How do you know that you're ready to invest? The first is to make sure that you have
liked the video and subscribed.
No, but the first one is that you should definitely already have an emergency fund. You need to have at least 3 to 5 months of your daily expenses saved up and put aside. And the second one is that you are completely debt-free, whether that be personal loans, car loans, or credit cards. But if you have all of these things sorted, definitely don't delay, because the sooner you start investing, the more your money will actually be worth. Not only will it be worth more, but here in Australia, you will pay substantially less tax the longer you haven't invested. And I'll explain any tax implications later in the video. So a long-term strategy is generally aimed at creating passive income, which then you save for your retirement. And there are two main strategies that I'll briefly talk about. One of them is taking a more passive stance, investing in something like an ETF on a regular basis. And the second is to invest in an individual company that you're feeling particularly bullish about. You buy and hold on to that for years, watching it steadily grow. The value of your money goes up the longer you can hold your asset after buying, provided that all dividends and returns are reinvested. A great example is Google and Dominoes, who both IPO'd in 2004. If you had invested $1,000 with Google, when they IPO'd, that $1,000 would have been worth $35,000 in early 2020. If you had invested that same $1,000 into Domino's Pizza, that $1,000 would have been worth $56,000 in early 2020. Now, this is a particularly good example of long-term investing because Domino's hasn't always performed so well. They actually took a big dip in about 2007 to 2010. So anyone who had had a shorter term strategy planning on exiting in 2008 or 2009 would have lost a lot of money. And anyone who had played the long game and invested in Domino's in 2004 for 20 years or so, they would not have even felt that dip, as Domino's grew by 2,000% between 2010 and 2017. So as you can see, the long term really mitigates any small drops that a company might experience. It removes any emotions, stress, and not to mention time and energy checking it every single day. And this is particularly beneficial to any young investors who can afford to play the 20, 30, 40-year long game. It can be tricky to pick a stock that's going to have such growth. I mean, who would have thought to back Domino's Pizza over Google? So if you're where I was a few years ago and you didn't really know where to start researching companies and how to find a company that has such growth, there is a really simple long-term strategy that you can use. I use a passive investing strategy called dollar cost averaging. I invest into the US market using my Stake app, and I consistently invest $300 every month into an ETF that mimics the S&P 500, which has historically given a return of 7 to 8%. But I'll give you a detailed run through of my exact investing strategy in one of my next videos. So be sure to subscribe and hit the notification bell so that you can be notified when that comes out. So you might be thinking, cool, that's great, but what do I do before I'm 65? I want my money to work for me sooner. And I have short-term goals that I want to reach through investing. This is where a short-term investing strategy comes in, where long-term investors normally buy and hold for upwards of 20 years. Short-term investors buy and sell within the year, and it can be as quickly as a month, a week, and even daily. But if you're in the position where you need to accrue funds for a specific purpose in a very short period of time, then stay away from the stock market. If you're investing for a short-term need, it's important to realize that you can lose your money quicker than what you think. One friend of mine had invested a substantial sum into the ASX with the goal of taking it out early the next year. Unfortunately for them, COVID struck and the ASX took a big hit back in March. My friend, knowing that they needed the money in the next year, was extremely stressed and exited, trying to reduce their losses. What they couldn't have known was that the market actually recovered quite quickly and faster than they had expected. What you can see from this story is the interplay of the immediate needs and the emotions of the investor with the volatility and the uncertainty of the market in a negative environment. I also have money invested, and during this time of extreme volatility and uncertainty, I was able to remove my emotions from the equation simply because I knew that I did not need that money in the near future. I had put it away with the intention of keeping it away for the next 20 to 30, 40 years. So my emotions were removed and I was able to just ride the wave without really even thinking twice about it. Don't get me wrong, short-term investing is not without its rewards. There are plenty of day traders and short-term stock investors who perform extremely well in their endeavors. But I would definitely recommend strongly evaluating your financial need and your financial situation before diving into this strategy. The last consideration that you should definitely be aware of and is often overlooked is tax. The way that you get taxed on your returns will differ depending on your long or short-term strategy. A stock is known as a capital asset, and when you sell a capital asset for more than what you pay for it, the result is a capital gain. The tax you pay on your capital gains depends on how long you had the asset before you sold it. Tax on your capital gains can get quite pricey, but fortunately there is a legal way around it. It's called a capital gains discount. If you hold your asset for more than 12 months, you'll get a 50% discount on the tax that you need to pay. What this means is that you'll only need to pay tax on half of your capital gains. So, for example, if you had been a genius and bought a Dominoes stock back in 2004 for the price of $4.71 and sold it today at $370.76, you would have earned a capital gains of $366.05. As you held your stock for over a year, you only need to pay tax on half your gains, being $183.02. And as you can imagine, this 50% discount has a huge impact, especially when you're dealing with thousands and thousands of dollars. So what strategy should you employ? Both investing strategies require a lot of research, and you should always understand where your money is going before you start investing. But the benefit of a long-term strategy is that the research is slightly easier to undertake for a complete beginner. You don't have to deal with the daily stress, and the overall strategy does not rely on your daily emotions. Most investors diversify their portfolio employing long-term and short-term. What I recommend is picking one, and once you get the hang of it, then you can begin to diversify. With the reduced stress and tax benefits, for me, I'd be starting with the long-term investing strategy before moving on to looking at short-term trading. I'd love to hear your thoughts on what investing strategies are working for you. If you have any questions or tips, please leave them down in the comments. I deeply appreciate it, and I'm sure our other viewers would love to read them. But in the meantime, good luck with your research, and we'll see you again in the next video.